Yeah, coming back to tech stuff, but earlier this session, Darren and Anthony has shared lots of great theoretical stuff. So I try to make my part, transfer pricing, a bit more practical. So bear me with a few minutes more. Thank you. 2025 is a really important year for transfer pricing. For last year's tax update seminar, we have seen new legislation, CBC reporting, new legislation and standards released. And we have noticed ATO's ruling and guidance on intangibles and on quantum of that are on the way. We also are aware multinational have so much to get up to speed, and the penalties for non-compliance continue to increase. So for these topical TP-related questions, if you are not too sure about what they mean to your business, the next few minutes will be dedicated to you. So as Darren mentioned earlier, from 1st July 2023 onwards, general class investors need to prove that the quantum of the debt level is supportable under transfer pricing rules if the debt involves an international related party. The ATO has made it very clear in the sense that transfer pricing assessment needs to be performed before ThinCap. And because the ThinCap, under ThinCap, the denial of deduction may be carried forward, but the denial of deduction under TP is permanent. So once it's gone, it's gone. So far, we have been assisting a number of clients over this matter. So let's take a look at a simple example as to how the process may look like. So in this example, say a general class investor is wholly debt funded for its Australian business. By way of entering into an inbound related party loan was $100, and the interest rate is charged at 5%. And through the TP assessment, the arm's length interest rate is determined at a lower rate at 4%, and the arm's length debt level quantum is also lower at $50. Because before July 2023, TP cannot intervene on the quantum. So in this scenario, the allowable debt deduction would be the 4% arm's length interest rate times the ThinCap safe harbor debt level, which is 60% out of the $100. So in total, it is $2.4 debt deduction, which is A and B boxes in this chart. But now, under the new rules, because TP can intervene on the quantum, so the TP allowed deduction becomes 4% times the arm's length quantum of the debt, which is $50. So basically $2 deduction allowed under TP. So the next step is to calculate the ThinCap outcome. So if the tax EBITDA of the entity is $10, the maximum debt deduction on the ThinCap would be $3, which is better than the TP allowed deduction. So in this case, the $2 TP allowed deduction stays. But what if the tax EBITDA of the entity is only $5? On the ThinCap, the maximum debt deduction would be only $150, so below the TP allowed deduction of $2. So that means on the ThinCap, there will be a further denial of $0.50. If your organization is a significant global entity, the next few slides will be highly relevant. So let's talk about the local files first. So from the income year, starting on the 1st of January this year onwards, the short form component of the local file is no longer lodged as a separate attachment, but to be incorporated into a standardized format along with Part A and Part B. So this means the taxpayers will lose the flexibility of using their own words for the short form completion purpose, but to disclose information in a highly prescriptive manner. And our in-house software has been upgraded and running to support this new format. So you may be wondering why there is such a change on short form, because the ATO intention was to improve the information comparability. for the short form information received from various taxpayers. But from the perspectives of the taxpayers, what do they get? Probably increased compliance time and costs. And I tell you why. If you go to the ATO website and you check the old ATO instructions on the short form and you click print button, the number of pages you get was previously less than 10. And how about if you go to the new ATO instructions on the short form? Guess how many number of pages you'll be getting? 50? It's 150. It's 150 pages, so it's no longer a short form, it's a long form. And under the new format, things like business strategies, overseas reporting lines, key competitors will need to be disclosed as per each key function of the entity rather than on a whole of entity basis. So if this is still relatively manageable, what is really, really challenging is the disclosures around significant restructure or new intangible related questions. So for restructures, they are defined very, very broadly, and certain restructures can be deemed as significant, regardless of its dollar value materiality. So, and also one thing is for each reportable restructure or new intangible arrangement, information such as each restructure step, each party involved at restructure step, Australian tax impact, global tax impact will all be disclosed. So that means the Australian entity will have to communicate extensively with overseas group entities just to collect certain information. Moving on to the CBC reporting exemption, they are getting harder and harder as well. So from this year onwards, there will be no more exemption for the local fund, even if the entity did not involve any international repatriating. So this is really a big change and increases the compliance cost. And in respect of the master file and the CBC report, exemptions would only be granted under the 3 scenarios. So previously it was 7 scenarios optional for exemption purpose. And there will be no more automatic relief for Australian entities that are dormant. And any exemption will only be granted for a limited 1 year period only. So lots of stuff to get on the compliance side this year onwards for SGEs.
So Yang, for branches of foreign banks, previously they don't need to prepare a local file because they only have branch dealings which are not
legal. They are not legal international repair dealings, but from this year onwards,
they need to prepare.
They will have to prepare as well. Yes. Okay, so as a Christmas gift, the Australian government also finalized and passed the legislation for the public CBC reporting. So effectively, this means for the income year starting on the 1st of July 2024, and if the global CBC reporting group has 10 million or more Australian sourced revenue, the global group parent entity must submit information to the ATO, and the ATO will facilitate in making it public on the Australian government website. And this obligation will operate in parallel with the existing non-public CBC. Compared to the non-public CBC, the public CBC has high reporting standard. For example, all the information must be sourced from audited financial statements. And it also covers information which is not required under the non-public CBC, such as the description of the group's approach to tax. For non-compliance of public CBC, both the group parent entities and the Australian entity will both subject to penalties. And further implementation guidance will be released by the ATO around the middle of the year. So watch this space, and our in-house public CBC software will also be ready by that time. So on intangibles, as Anthony mentioned earlier, that the ATO are working on some rulings and guidance, particularly on the mischaracterization of intangibles, whereby the Australian royalty withholding tax are not duly paid. And since last year, also the new RTP questions have been introduced to require taxpayers to self-assess the risks in association with any intangible migration arrangements. So intangible is really a continuously evolving topic. So watch the space closely and making sure that documentation is put in place to evidence your self-assessment of any intangible arrangements. So that's really important for any taxpayers involved in this space.